Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Paysafe stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Paysafe is an online payments company. It operates in over 40 countries. You could think of it like PayPal that also accepts cryptocurrency. It owns Neteller, Skrill, and Paysafe Card. Neteller is a digital wallet that allows consumers to add, withdraw, and transfer funds to and from merchants and other people. Skrill is a product that allows payments and money transfers to be made through the internet, with a focus on low-cost international money transfers. Paysafe Card is a way for customers to make online payments without using a bank account or credit card. The company is number one in iGaming transactions. It processes 100% of the poker, casino, sports betting, and iLottery in Canada. It is also active in 19 US states. It acquired PagoEfectivo and SafetyPay to gain exposure into Latin America. Paysafe was funded by a SPAC, a special purpose acquisition company, is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In March 2021, the merger was completed and Paysafe received $1.2 billion. The SPAC that acquired Paysafe was Foley Trasimene Acquisition II. The company is headquartered in Bermuda and was founded in 1996. It can be found on the New York Stock Exchange. Let's get started with the model. This is a mid-cap company, 2.8 billion market cap. They're trading at $4 a share, and they have 724 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow looks really good. It's positive every year except 2018. Lots of companies we look at have negative free cash flow for a really long time. They're already positive. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grew nicely from 1.1 billion to 1.4 billion. Then from 2019, it looks like it's pretty flat. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. Similar to their revenue, it's been pretty flat since 2019. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. And that was lowest in the trailing 12 months at 79 million. Below that is the interest they pay in their debt, and that was the highest in the trailing 12 months at 184 million. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and then below that is their net income, which is negative every year. They did receive a tax credit in 2019, 2020, and the trailing 12 months. So you can see their net income is higher than their pre-tax income. But I would just focus on operating income when I look at the income statement, not net income. Operating income is a better indicator of how the company is doing than net income. And they do have positive operating income every year, so that's a really good sign. It seems like they pass through a lot of write-offs that are dragging down their net income. That's why they have these big negatives in other income and expenses. It does seem like they have a lot of debt because they're paying a pretty high interest rate on their debt, high relative to their revenue. Here's their income statement from their latest 10Q. This shows us the first 9 months of 2020 and the first 9 months of 2021, the third quarter of 2020 and the third quarter of 2021. So their revenue in the third quarter was a little lower than the third quarter of 2020. Here's a breakdown of their third quarter revenue, 354 million, and that's broken down into their three divisions. Integrated processing is their biggest, 187 million, digital wallet, 84 million, and eCash solutions, 90 million. Integrated processing is focused on card not present and card present solutions for small or medium-sized business merchants. So you can pay with a credit card or you can pay with cash. Their digital wallet business is made up of Skrill and Nutella. eCash Solutions allows people to use cash to buy things. This is by using your Paysafe card. Because some people prefer to pay with cash than use their credit card. They just don't feel comfortable using their credit card. Maybe they don't want to get stolen, or they don't want things traceable. Some people don't have access to a credit card. They don't have enough credit or a debit card, so they have to use cash. Their solutions give you 70 payment types in 40 currencies around the world. Cost of services are the expenses directly related to each division. You also have selling, general, and administrative expenses for each division. Even though integrated processing brings in the most revenue, it has the lowest margins. The EBITDA is only $44 million. The other two divisions have a little less than half the revenue as integrated processing, but their EBITDA is pretty similar. So if they're able to grow and scale, it would make more sense to focus on digital wallet and eCash solutions. It's interesting to see that their revenue went down 1% in the third quarter of 2021 compared to the third quarter of 2020, but the volume of their transactions went up 19%. In the third quarter of 2021, they processed $5 billion more of transactions when compared to the third quarter of 2020, but their revenue is lower because their revenue is the fee they charge per transaction, and certain transactions have higher fees. So it seems like they had more lower fee transactions in the third quarter of 2021 versus the third quarter of 2020. Their EBITDA also went down 1%. A bullish sign is their free cash flow went up 19%. So they're generating more cash. Of course, you have to dive into these numbers a little more, especially free cash flow, to see why it went up 19%. This shows us each quarter in 2021 and the total volume they process in each of their three divisions, their take rate. Take rate is like their fee. It's revenue divided by gross dollar volume. So the take rate in eCash is the highest, and that's where they have the lowest gross volume. That's why their revenue went down, because eCash is decreasing each quarter. Actually, digital wallets is also down from Q1 to Q3, but integrated processing is up from Q1 to Q3. It's down a little bit from Q2. Let's go back to their income statement. So we talked about cost of services and SG&A. They had $62 million in depreciation and amortization. They had a really large impairment of $322 million. That's why they have negative net income, is this big asset impairment. If it wasn't for this large impairment, they would have positive net income in the third quarter. They did have negative net income in the third quarter of 2020. They also had a pretty sizable impairment in the third quarter of 2020. But not nearly as big as the third quarter of 2021. This impairment is related to their digital wallet segment. The company says due to lower forecasted cash flows in the digital wallet segment, we concluded an impairment for the digital wallet segment. The digital wallet segment experienced decreased revenues associated with certain legacy merchant relationships, and also reduced forecasted cash flows associated with these merchants. Let me try to explain this impairment in an example. Say, for example, I have a company that manufactures furniture. I'm looking to grow my business, so I want to acquire another company. And I find this other company, and I'm willing to pay them $1 billion to acquire the entire business. And let's just say they have no liabilities. The only physical items they're giving me is their buildings, which are worth $200 million. That's where they manufacture their furniture, and the equipment inside the buildings, which is $100 million worth of equipment. So they're giving me $300 million of physical products. Why would I pay $1 billion if they're only giving me $300 million of items? So this company I'm acquiring, they're not providing me anything new. The furniture they make is nothing special. It's not different than my furniture. So why would I pay anything more? The reason I'm acquiring this company is for their customers. I don't really care about the building and equipment. I'll take it. They are assets that have value, but I'm really acquiring this company for their customers. That's what I really want. I want to grow my customers. It's hard to get customers. You have to do lots of marketing. Then you have to build those relationships. They've been around for 100 years, this company. They have a lot of relationships. They have a lot of great customers. And I've been in business 50 years, and I've built those relationships with my customers. But by acquiring another business, I get a whole new batch of customers. And how do you value customers? Customer relationships are intangible assets. So how do you put a value on an intangible asset? There's different ways to value customer relationships. You may look at the total customers this company has, the average time they've been with you, the average amount of money they spend per year. Then when you gather all of that data, you forecast it out into the future and then discount it back to today's dollars. We estimate the value of those customer relationships is $500 million of profits. So that's an asset. It's an intangible asset of $500 million. Since I'm paying $1 billion for this company and we identified $800 million of assets, that means we're paying $200 million more than the identifiable assets. So the rest gets booked to goodwill. Goodwill is the purchase price above identifiable net assets. Goodwill is not amortized. It stays on the balance sheet forever unless we impair it. Goodwill is tested annually for impairment. Customer relationships are amortized. We may amortize customer relationships over 20 years, $25 million a year over 20 years. After 2 years, on our balance sheet, we would have customers as $450 million, $500 million minus $50 million of amortization. So pretend my company is named Scott's Furniture. I acquired Jim's Furniture. 2 years after the acquisition of Jim's Furniture, the value of the customers on my balance sheet is $450 million. $500 million minus $50 million of amortization, because I'm amortizing $25 million a year. But let's just say after 2 years of the acquisition, half of Jim's customers don't want to do business with me. They like Jim so much that they just don't want to do business with anyone else. So I would need to pass through an impairment because I initially bought Jim's business thinking I would have all these future revenue streams from his current customer base. But that's not happening because a lot of his customers aren't interested in doing business with me. So I recalculate the value of his customer relationships based off of the customers I have left of his. And I calculate the future value of his customer relationships is $250 million. On my current balance sheet, the intangible asset, customer relationships, is $450 million. But I'm saying it's worth $250 million. So I have to pass through a $200 million impairment onto my income statement, which will reduce my net income dramatically. But you can see that's a non-cash item. It's not like I had to pay somebody $200 million. It's just the idea that I may in the future not get as much money as I thought I would have gotten. So that's why it's a non-cash item. It doesn't affect cash flow, but it looks really bad on your income statement. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So they are generating a good amount of operating cash flow each year. They had the most in 2020 at over $400 million. Then you have capital expenditures, which are investments in property, plant, and equipment. Most of their CapEx is developing their software. Operating cash flow minus CapEx gives you your free cash flow. And they also have pretty good free cash flow in 2019, 2020, and the trailing 12 months. They added over $2 billion of stock in 2018. They also issued a lot of capital stock in the trailing 12 months when they IPO'd. But Yahoo Finance didn't pick this up. But I'll show you later their cash flow from financing section, and that shows you how much they issued in the IPO. You can see they added a lot of debt in 2018. They also added a lot of capital stock. And it looks like that was to acquire some businesses because their investing cash flow was over $5 billion. When you acquire another company, the cash you paid goes into investing cash flow. Also, CapEx is part of investing cash flow, but you can see that CapEx was a lot smaller than the $5 billion. Lots of SPACs seem to IPO so they can pay down some of their debt, which they did. They paid down over $1 billion of debt in the trailing 12 months. Here's their operating cash flows from their quarterly report, the first 9 months of 2020, the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. So we start with a net loss of $200 million. The reason they had that big loss is from the asset impairment, which is a non-cash item. So we add it back here on the statement of cash flows. That was $324 million. We also add back depreciation and amortization. Even though the income statement said they have a tax credit, they didn't actually receive money from the government. It's an accounting tax credit, so they carry it on their balance sheet. and they could use that credit in the future to offset future income. Since the tax credit increased their net income and it's a non-cash item, we have to minus it out here on the statement of cash flows. We have to add back stock-based compensation of $92 million. We also have to adjust for changes in working capital. They paid $176 million to their customers because they're constantly receiving money and they usually hold it overnight or maybe 2 nights. And they had a cash inflow of $60 million from their customers. But if you track this over like a 10 or 20 year period, the cash inflows and outflows, it'll equal 0. Even though they reported a net loss of $200 million, they actually generated $93 million of cash flow. Last year was a net loss of $124 million, but they generated $173 million of cash flow. That's why operating cash flow is a better indicator of how the company's doing than net income, because net income includes all these non-cash items, which can really skew the numbers. Here's the investing and financing section, the first 9 months of 2020, the first 9 months of 2021. They spent $4.5 million of PP&E. They spent nearly $50 million from acquiring other companies' customers. And they spent $120 million from acquiring other businesses. So in their investing section, they had a cash outflow of $229 million. In their financing section, you can see they received $1.2 billion from the IPO, the reverse merger from the SPAC. They took on $2.2 billion of debt, but they paid down $3.3 billion. So in their financing section, they had a cash outflow of $95 million. Last year was a cash outflow of $42 million. Here's the equity section on their 9/30 balance sheet. They have $2.5 billion of equity. They raised $2.9 billion from selling their business, and they lost $500 million from running their business. Let's look at the capital structure. $2.5 billion of equity, $2.2 billion of debt. They're 52% equity, 48% debt. I gave them a whack of 10%, which is a little higher than Simply Wall Street, a bit lower than Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $3.6 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $3 billion. We divide that by 724 million shares. And we get a calculated stock price of $424. They're trading at $382, so they're trading at a 10% discount. It's a buy according to the model. I did a video on this stock in August when they were trading at $846 and my valuation was $644. They've come down a lot since my last video, well below my calculated stock price. Their annual revenue is projected to increase 6.2%, so I increased their revenue 6.2% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. I summed up these 3 free cash flow numbers and I divided by the sum of these 3 revenue numbers, and that comes out to 15%. So I multiplied their future revenue by 15%. That's how I got their future free cash flows. Simply Wall Street's higher than me. They're at 675. They're saying it's 43% undervalued. 5 analysts priced this stock and the average price target is 538, the lowest 4, the highest 7. The company's revenue target was 360 to 375. They fell below that to 354 million. This is for the third quarter of 2021. They also missed their gross profit target, but they did beat their EBITDA and cost of services target. This is where the stock has been trading since it was acquired by the SPAC. When a SPAC starts out, it starts at $10 a share. When they announce an acquisition target, the stock price usually goes up a lot, and then there's a sell-off. It just seems like it keeps going down. This seems to be a pattern with a lot of SPACs. The stock is down 75% in the past 52 weeks, while the S&P is up 23%. The 52-week low was 318, the high is 20, and the stock is trading well below its 50-day and 200-day moving average. This is a pretty popular stock. Over 10 million shares are traded every day. Of the 723 million shares outstanding, 344 million are on float, 52% are held by institutions, and 3% are shorted. They employ 3,400 people. If you invested $10,000 when this company started trading, you would have lost over 60% of your investment. There was a big buy recently from Canay Holdings for 5.7 million shares. Venture capital and private equity firms own 25% of the company, the general public 24%, institutions 24%, private companies 22%, and hedge funds 5.5%. The biggest shareholder is Pi Holdings at 22%. I think this is part of the SPAC that acquired this company. The next biggest is Blackstone at 17%, then Cannae Holdings at 8%. The founder of Cannae Holdings is William Foley. He was the person who started the SPAC that acquired this company. The next biggest is Fidelity, then Third Point. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They do have a good price to sales at 1.9, that's stock price over sales per share. And they have a good price to book at 1.1, that's stock price over book value per share. Let's look at their non-current assets. They have 17 million of deferred tax assets, 15 million of PP&E, 33 million of operating lease right-of-use assets. They have tons of intangibles, 3.5 billion of goodwill. Remember, goodwill is the purchase price for an acquisition minus their net assets. And they have 1.2 billion of other intangible assets. Remember we talked about this earlier when they did the asset impairment on their customer relationships? Here are the original value of their intangible assets. Brands 176 million, software 800 million, customer relationships 1.6 billion, and computer software 31 million. But they amortize those assets each year. They amortize 900 million of those assets. And they also impair assets, like they impaired the customer relationships. They've impaired that 450 million. So the current carrying value of those assets is 1.2 billion. When you hear carrying value, that means the value of those assets on their balance sheet. They only have a 1.4% return on invested capital. They can only cover 40% of their interest payments with their operating income. They have a negative ROE. Their current ratio and quick ratio are above 1, so they can cover their current liabilities with their current assets. Here's a list of their current assets: 262 million of cash, 1.2 billion from customer accounts. This is cash that's being sent from their customer to the recipient of the cash. A lot of banks or financial institutions sit on cash for a day or two before they send it to the end user. And you can earn a lot of interest. Even on one day, having $1 billion of cash can earn a lot of interest because every day you have $1 billion or several $1 billion of cash sitting in your account. So you can invest it in overnight investments. 130 million of accounts receivables, 152 million of settlement receivables, and 69 million of prepaid expenses. Here's a list of their current liabilities: 240 million of accounts payable. That's how much Paysafe owes other companies, and 1.3 billion due to their customers. So at any given moment, the company may have several $1 billion of cash sitting in their account that need to be transferred over. They generated 181 million of free cash flow in the trailing 12 months, and they have 200 million of working capital. Since they are generating positive free cash flow, it does look like they have enough money to get through the next 12 months without adding any more debt. The best way to look at ratios is to compare them to companies in the same industry. There are 73 companies in the same industry as Paysafe. If they have a number in red, they're doing worse than average. If they have a number in blue, they're doing better than average. They spend less in CapEx than the average company. Their debt to equity ratio is slightly better than average. They don't pay a dividend. They are generating more free cash flow than the average company. They rank 39th in market cap at 2.8 billion. The average is 13 billion. Their price to book is a lot better than average, but they have a negative tangible price to book value because they have so many intangible assets on their balance sheet. We can't look at their PE. Their price to free cash flow is a lot better than average, so that's a really good sign. Price to sales is also a lot better than average, and they bring in a lot more revenue than the average company. So to summarize, I have them trading at a 10% discount, and this stock has really gotten beaten up since it IPO'd. It looks like it could be a great opportunity for lots of upside. And they're not doing that bad. They're putting up positive free cash flow. They're not really growing much of their revenue, but at least they're not losing money. And it seems like there's some big institutions backing the company as well. You really never know. This stock may hit $40 this year and you could 10x if you buy it today. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and the ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.